Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn, Focus Compounding, sitting next to Geoff Gannon. Jeff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you're tuning in with us, first of all, welcome. Second of all, be sure to check out all the content that we put out there on the internet. Go to focusedcompounding.com to get access to stock research and write-ups. If you're interested in learning about our money management services, there's an Invest With Us tab at focusedcompounding.com, or you can reach out to me, Andrew at Focus Compounding. We have a fund for qualified investors and managed accounts for other individuals if you can't meet that threshold. Reach out to me. And of course, if you're watching on the screen right now, Twitter is the best place to get everything that we put out, which is at Focused Compound on Twitter. So first things first, did you see the movie House of Gucci?
I did not.
Oh, you didn't? I actually think it's a movie you would like because it was much more about like the family, like the business and stuff of that side of it. I don't know why I just thought of that, but in today's podcast, we are going to do our free-form podcast and chat about what's going on in the world and see where we end up. So first things first, something that's on everybody's minds, or a lot of people's minds, is everything that's going on with Ukraine and Russia.
Okay. We haven't talked about that on the podcast ever, right?
No, we have not. So Russia is...
As of this recording,
invading, not invading. Some people say it's an invasion. Some people say it's not. I think call it what it is. They're moving into Ukraine. Governments around the world are starting to impose sanctions towards him and Russia. It's a very interesting time. And markets have been already pretty volatile this year, but on news of this, I mean, we're not market commentators, but I don't know where markets close, but there were, futures were getting hit, oil's going crazy. So I'm just kind of curious. I mean, is there anything about this situation that stands out to you other than, as an American, as we don't want war, all that sort of stuff from an investor standpoint?
No, I was a little surprised early on that people weren't more convinced that this was what was going to happen. But I don't think it has a big effect on markets and things like that. I mean, obviously the Shiller PE of Russian stocks was already like the lowest in the world, and probably because of concerns about things like this. It affects some commodities. Obviously Ukraine and Russia are huge wheat producing places. And, it can have effects on natural gas, oil, some metals that are used in some stuff like electric cars and things like that. Like nickel and stuff are required. But, I don't think that the initial, it's too hard to predict. The initial things with all of this are stuff that markets react a lot to. And it's hard to predict how they would react. I mean, some people might buy U.S. bonds and things if they're concerned about something in the area that they're in. Obviously, it just increases risks of other stuff happening in the future when you have armies operating that close to each other and all that. So, but we don't know how that will develop over time right now. There's not been anything like this since probably the conflict in Yugoslavia. So we're probably talking about over 25 years or about 25 years or something. So just risks that stuff can happen is just, not been the case. The only major wars that have happened have been in like the Middle East and places like that in the last 20 years.
Why were you surprised that investors weren't more convinced?
Not investors, just reporting on it and stuff.
Oh, people.
But they're just reporting that there was some question as to whether this would really happen. During the Olympics and stuff, they kept saying, we expect that they'll do this and showing the troop build up and stuff. It was just a little surprising how much people were saying what's going on and maybe they will, maybe they won't, that sort of thing. Yeah.
So I wanted to pull up this chart and it really has a lot of different names.
Okay.
And this person tweeted, when would the market crash? Or has it already crashed?
Okay.
So a lot of high flyers on here, but then there are some names that, BBBY, PayPal, Square, Penn, Sam was actually Sam. Boston. Yeah. I literally look at my notes right here. I literally have Sam because I wanted to go over that, but we actually talked pretty in depth about that in the last podcast, Celsius.
I've looked at some of these companies because people tell me to look at them. I mean, I can't tell you how many of these people sent me to say you have to look at this, and so I've read about it. Right? Is that up? That's
Upstart.
Yeah.
APST. Is that what that is?
And then there's
Or
Tree.
UPST.
There's
that's like a lender, right?
Yeah. Then you got your online real estate things. You got a couple of them, right? That's Redfin or something right there.
Yeah.
There's actually quite a few of those. So I've looked at okay. So I've looked at several of these, and it's because people sent them to me about.
So like when they send you Tree, what's the context of the email? You have to take a look at this. This is the future.
No. Sometimes they like something and they think that it's interesting and that we invest in financial services things and they want a reaction from me about it. And I give a little comment about it. Let's type in UPST in like QuickFS.
Upstart Holdings.
Yeah. So if we do the business description,
let's go annual. We'll do business description. Operates a cloud-based artificial intelligence, AI, lending platform. The company's platform aggregates consumer demand for loans and connects it to its network of the company's AI-enabled bank partners.
So I think I read about it. I read their 10K or whatever it was at the time. I think it was a 10K, but it could have been a prospectus. And, marked up some stuff and just gave my reaction as to what I thought they were doing, whether others could do it, things like that in terms of the lending. So
what are your thoughts on this more systemized, approach to lending? Are we the old dogs here that like banks where the lenders are very important part of the company and the culture and all that sort of stuff?
I don't know.
Are we the horse and buggy?
I don't know how much the stuff that some of these are a lot of different companies, but some of them are talking about, is that different from what companies are doing? And so that's an issue. For instance, like Progressive, let's say, there's a high frequency of data that they have and stuff. So some of these things that talk about how much they do with AI and data and all those things, a company that's doing car insurance that has a lot of information on claim stuff all the time is probably detecting some patterns and things using much the same sort of approach. And has been for a while,
Mm-hmm.
I don't know how many of these things, like people talk to me a lot about FICO, that it's a very different company now. I don't know if it's that different of a company. It started to stress certain things about how it presents itself to investors, but FICO was always a predictive analytics company. Not a lot of other companies talked about predictive analytics, maybe like Netflix, and Amazon and stuff said like, we can predict what show to put on next that you'll watch and those sorts of things. But that's the only thing that they do. They're not a credit reporting thing. So the only thing they have is the prediction stuff. They're using someone else's data to do that, and then they're applying their stuff to it. So, but presenting yourself in a different way may help your stock sometimes if you're seen as being focused on those sorts of things. And so, who knows? But then it worries me because then how you present yourself may be less accurate to what you're doing. And you may have always been doing these things. So it's a lot like ESG stuff. I read some things about some companies, and I'm not really sure how much they are focused on these ESG things as a priority, or how much it's just that they're devoting a large part of the annual report to that, when that's not really been a change in how they approach things.
Mm-hmm.
And I feel the same way with technology things. I think some just put in more and more information about technology stuff that they didn't before, but I'm not sure that they're doing things very differently.
Got it. It's interesting when you see some of these names that have just been, hit hard, right? Sam, for example, or any other ones that are on this name. I mean, pick any name. I mean, this is, kind of applies to everything. So if you sell a stock and let's say you made 300 or 400% on it, but then the stock just crashes in the near term or kind of, after you sold. Is there was there skill there? I guess skill in trading and getting out a lot of times.
Right.
And this is all we're literally talking months here and years here. So it's hard to judge skill. So I'm not being exactly fair because I'm saying, well, you sold out at the top and now we're judging a few months later where the stock has crashed. But these are obviously pretty significant moves. But how do you judge that? Because we've met with people before where sometimes they're like, well, I invested in this name and I made a lot of money, but then the stock fell kind of shortly after I sold. So I don't know if that was kind of like a skill thing or if I got lucky.
Yeah, I mean, I'd say you got lucky, but people who are doing this are traders and they may have been intending to anticipate people's reactions to things.
Yeah, so it's what type of game you're playing, right?
Yeah, so if this is what you were trying to do, then that's what skill is figuring out how the crowd's going to behave before they do and then being earlier to get out and everything. Then then you have skill. Yeah, and maybe that's what some people were doing with Playboy or something like that.
Yeah, that's another one we could look at.
Yeah. I guess all SPAC things are down a lot, basically, just across the board, regardless of what business they were in.
Yeah, I was wondering if it'd be a good spot to start to peak a little bit at. Because, you did have there were some good brands that came through SPACs and stuff like that.
Yeah.
And in the market capitalization, that's considered a small cap and even smaller.
Yeah. However, some of these are, I'm be honest about it, they're not cheap after they've dropped by these amounts. Do we have quarterly stuff for Playboy?
Yeah, I was looking at theirs last night at 11 o'clock in bed. And they've also issued a ton of shares.
Okay, so what was their revenue most recent quarter?
Since they went public. 58 million.
58 million. So let's say they're at 240 million. Let's give them that because they'll probably grow a little, whatever. So it's 250, let's say. So they're at a run rate, that'd be 250 million revenue. What's their market cap?
650 million or something.
Yeah.
Market cap 650 million, EV 808 million.
So 2.5 times sales or something like that. I mean, 2.5 times sales is not a low price, really. We don't know what their margins will look like and everything, but for a business that has gross profit of 50% or something, if it turns out the business is good and it's going to grow and all that, that'll have turned out to be a cheap price. If not, it will not have been a cheap price. It's not on the face of it a very cheap price. That's a fairly normal price. So it took falling. What did this one fall? 60% something. How much did Playboy come down from its highs there? Well, don't you have that list there?
Yeah, but I just want to look at a chart. Okay. On the chart itself,
75%.
Yeah.
Yeah, so down 75% to a price that is, it's a.
So it looks like peak was around $50 a share.
Okay, but you got to that peak all in a couple days.
Yeah,
I'm exaggerating a
couple
little
months,
bit.
Yeah,
a couple
5 minutes.
If you look, it's really at that point there that you go up by a lot. If we think about where we are now, all the return above the level that they're talking about happened in the matter of what?
Less than a year.
Oh no, the increase over all that time is less than a year.
Yeah.
But the speed of the increase really happens it's literally like a month. Yeah.
Crazy.
Yeah. But I read about it. I read their presentation and stuff. So, because I had some interest in it because I was wondering what they were doing. And, I think I mentioned it. I thought that there was some evidence that they have popularity in Asia and some evidence of popularity with, what did they call them? Gen Z. Yeah. And so that interested me because historically they hadn't been, this brand as a legacy brand hadn't been, and it doesn't have much, people don't have a lot of interest in it from what it was traditionally in, And I think we talked about that series it was about the
Amazon
Geoff
series.
Yeah.
That's great show. Docu-series. So we talked about Vector Group on the last Snap Judgments podcast that we did. And after that podcast, I actually was just kind of bopping around and I saw that they were spinning off, and they have completed the spinoff as of the end of December, their real estate brokerage business. And I thought it was very interesting because here you have a business that is in cigarettes and tobacco, and they spun off. I mean, because really in the podcast, you were talking about how it was always kind of odd that they had like a real estate arm and they also had a cigarette arm. And they spun off, the real estate division. So really you have sort of the two different shareholders. Vector pays a dividend. The new company, Doug, as the ticker, is not going to pay a dividend. Two completely different industries. So I was thinking, I was like, that's a kind of a situation that I think Joel Greenblatt would, be interested in learning a little bit more about, because you could get just sort of that selling, right? And it's spun off at the end of the year, right around, I think, like what, $11 or $12 or something like that. Okay. And it's trading today at $6.94. So it has gotten completely punished. The CEO of Vector went over to the new company, although I did say that they're going to be CEO of both. So it's really like it was just a spinoff. And I thought it was interesting. And what's the market cap on it? Like 600 million. It's not pulling through QuickFS yet, but really, like when I was thinking about it, I was like, is this something Geoff would be interested in? I was like, well, probably not. The brokerage business in general. Got a lot of volume,
right?
Yeah.
It looks like you do, yeah.
Brokerage business in general, I don't know. Even though they're, they have a good brand, have been around for a while, high-end real estate, but at the right price, I mean, if something continues to get smoked, and they also spun off with $200 million in cash, no debt. So it's like an EV of what, like 400-ish million right now, if the EVs, or if the market cap's close to 600 million.
Yeah, I don't know. I mean, what you said is true about the dynamics that could lead to selling, and it has happened with a spinoff. It's not an area I know a lot about. I don't know about management here. I don't know about being the CEO of two different companies like that. I also don't know how real the spinoff is. Like you said, if they're putting cash with this business and all the debt is staying with Vector and all that from like a creditor perspective and stuff, whether this is questionable to people. So,
as in they could run into issues with that?
Yeah, if you're operating the business much like you were before, you have some of the same people involved in managing it that were managing it before. You put the cash with one business and kept all the debt at the other business, and you spun it off. Yeah. As long as they don't run into any financial problems, it won't turn that the remaining cigarette company doesn't run into any financial problems. It won't turn out to be an issue. But obviously, if you're a creditor or something, it's alarming.
It seems like they could have spun it off too, at the close to the top.
How many spinoffs have we seen recently where they didn't load it up with debt?
Yeah, I mean, none.
How many have we seen where they have cash and not debt?
Yeah, none.
So the spin-off, isn't it possible that the actual spin-off here is of the remaining company?
Meaning what?
They want to separate the broker. Okay. And doesn't it seem like management spends as much time or more with the brokerage stuff? And
that was your interpretation.
That was my interpretation from before the spin-off, from long before the spin-off happened. I don't know if that's true, but I haven't heard a lot of talk about cigarettes, and I have heard a lot of talk about the New York real estate. And New York.
Let's see if we can find for some reason going SEC.gov is not working for me, but maybe it's not pulling up.
So I don't know which side is how much did Vector drop by when they spun it off? If you can go to Vector's chart.
Yeah, was like in the 20s, I think, maybe. Now it's like, we looked at like around 11. Yeah. Oh, just kidding. So then end of 2021. So yeah, $13 a share to $11.
Yeah.
Color me surprised.
So, I mean, did you create a lot of value by doing that? Spin us off with any value. And this stock doesn't drop. Then you've created value out of nothing. Yeah. If there's anything left over for Doug as a stock, then the combination of the two has more value. I mean, we have to do it where you compare. We could do the calculation where you compare the two and what it ends up with out of them. But it seems to be possible that it adds up to more value there. Because why doesn't it? How big is Vector? Their market cap now.
Let's see. Would it be under 1.7 billion?
Okay. So you should have dropped more than 10% just based on quite a bit more than 10%, just based on that you distributed cash to another entity that you no longer own.
Yeah, and the market cap of
they don't have the information yet.
We could pull it.
Yeah. How many shares do they say they have? We just need the number of shares.
So the amount to be registered 11.6 million.
Okay, so let's say that's it, and then so that's what, it's a $7 stock now, so that's 77 million.
Mm-hmm.
I don't know the details on that because that doesn't seem like it could be right. So that must have been, maybe that's a placeholder registration or something.
Your interpretation of it, it is weird though, like that there's still going to be the CEO of Vector and the CEO of Doug. So it's like, why did they do it? The separation.
Yeah, well, maybe for the reason that seems to be what happened, which is that the market would place a higher value on the two if separated.
Mm.
Yeah. I just have the issue though, is that you have a lot of debt at Vector. So I don't know about spinning anything off of it without taking the debt and putting it on that. Like say AT&T did a spin-off of something. Say they spun off Warner, right, into Discovery, and they didn't put any debt on it, and they gave it some cash. How would AT&T's bondholders feel about that, given how much debt AT&T has? So that's the only issue that I would see with that. And then just the issue that I don't know if I'd be as interested in that business. So I just think in terms of the two things there, maybe the spinoff in a sense is the thing that's left over. That happens sometimes, that the purpose of the spinoff is to have to separate the spun off company from the remaining company. Because the actual enterprise value of Vector is very large because it has a lot of debt. So you may be able to get a lot of like market value from it by separating it out, which is maybe what we see here. Like it might not have been getting much credit for it.
Mm-hmm. And when you talked about it as well, it does seem weird that real estate companies attached to a cigarette company.
Right, but you haven't resolved that if you haven't changed the management. You still have management of both things. Isn't it odd that you'd have similar management between a cigarette company and a brokerage company, and that the two are both public companies?
Yeah. Mm-hmm.
Right, so like, I don't know. I mean, part of the thing with spinoff sometimes is to give different management and to have management become the top management of a public company and stuff, and you're not really doing that here. So I don't know what the reasons for it all are.
Let's see. What are some interesting things that you've come across recently, or stuff that you've been thinking about? Anything in particular?
No.
Just continuing to chug on and look at a bunch of different companies.
I mean, everything's dropped. I mean, some of the things we saw have dropped a lot more that we were talking about from last year. But this year, a lot of stuff has all dropped together for no reason. So I mean, the problem is there isn't a lot of stuff that's dropped by a lot more than other things have. Mm-hmm. So it's not a good kind of volatility for us. It doesn't help. The market may be volatile. You could decide if you want to get in or out of the market, but we could chart so many different things that are in completely different areas and they've dropped at the same rate. So like the headlines might be, oh, this is because of fears of inflation and the Fed raising rates, right?
Yeah.
Well, if it was though, then why would Alico be down by the same amount as, say, a bank, which is down by the same amount as an energy thing? And in a lot of cases, they all are down by those same amounts.
Is there just like that trickle down effect where if they're selling off their other portfolio, they're going to sell some of a company like Alico that is in the orange grove business and has land and would actually benefit from inflation.
Right.
But it just kind of gets grouped into that. I mean, because it's not like Alico, I don't believe, trades on any major exchange or is in any index or anything like that.
It trades on exchange, but yeah. So how big is it in terms of its market cap?
245 million.
Okay, yeah.
So on the NASDAQ.
I mean, even ARK technically is on the NASDAQ. I mean, there's lots of stocks that are tiny on the NASDAQ. Yeah, so I mean, I don't know exactly what it was down this year, but I think it was down pretty similar to the market at one point. And we mentioned, and it's a company that mostly has ranch land. And yeah, look at that.
Oh, you could just click it.
Okay, year to date.
Year to date. So the market's down 9.7 and Alec goes down 12.2.
But just, there's not a lot of difference dated. I mean, they're moving at the same time.
Sure.
Yeah. So why is that? If it is about interest rates and things, it doesn't make a ton of sense. If it's about the economy, let's say it's about the economy. Is orange juice consumption going to change dramatically if there's a recession, if there's a boom? Orange juice consumption has nothing to do with economic activity. So it's not that. Inflation. Well, the S&P might suffer from inflation in some of the things, but Alco would benefit, or they might both suffer. I don't know. I don't know how that would happen. Alco has mostly long-term fixed debt, so it doesn't have a short-term funding need for that. In fact, it has excess assets that can be sold off, whereas S&P 500 funds itself with more short-term debt. So I don't know. I think the answer is just that the same people who are in those things take money out of stuff and put money in. I mean, we don't talk about like the market and sentiment and all that, but my guess is it just has to do with people doing certain things, different kinds of people. So probably smaller investors have been putting money in, and professionals have been taking money out. That's probably what's been happening of the stock market. And so that's why you're seeing certain moves that are kind of large at times, because the explanation is right that it has to do with expectations about short-term rates, right? But if you look at what's up and down, it doesn't make as much sense. That makes a lot more sense with what happened last year. Much more sense. When we talked about the end of last year and what stocks were up and what stocks were down, that was much more consistent with people trying to predict what would happen with interest rates in the future. This year, the moves aren't consistent with that.
So you're referring to like financials?
So financials and energy did well.
Yeah.
And some other things like tech companies with no earnings did badly. Right? But financials and energy haven't done that well. So, they've actually done quite poorly versus the commodity pricing of their commodity. They, in the first 2 months of this year.
Yeah, they had I think 1 week. It was like the first week of, quote unquote outperformers are doing well. And then it's just basically been down.
Right. But that could be because of, anticipation, you could say. So that the market, so in stocks, people were anticipating what stocks would benefit from rising rates. And that somehow that happened faster than when the bond market and the market for Fed funds futures and stuff like that adjusted to that fact. It's hard to believe that, but it could be true. So people investing in, say, energy and financials and stuff were better able to see what was going to happen than people who were trying to predict what the Fed was going to do and what the bond market was going to do, because they seem to have predicted it several months ahead of time, right? Like those things responded in the last half of last year, and then the changes in the actual rates happened in the first 2 months of this year. Maybe.
Yeah, the weird thing is I feel like the sentiment has changed, but the actual information has largely been the same since the end of Q4. I guess the Fed's changed their tone towards inflation not being...
interest rates have changed a lot because of that.
Yeah, the Fed's changed their tone. Like, we should retire the word transitory. But I feel like everyone involved with markets and following a bunch of companies, it didn't seem like it would be like that. But the total sentiment has, everyone's accepted the fact that rates are rising. You see that with rates. You see that with mortgage rates.
Yeah, we did a podcast at the end of 2021 where I think we said some places are predicting 3 or 4 rate increases. Now they're all at 5 to 9. So what for consensus of things now are probably around a total of 7. Something like that. So, but what's interesting about that is, in a sense, what we were just talking about, like the financial stuff, the way those stocks performed last year kind of anticipated that, right? But that doesn't make a ton of sense, because then you'd be saying, well, but the bond market wasn't able to anticipate that. and people whose job is to watch the Fed and give notes to clients on what to do and stuff, they couldn't anticipate it. They were slow to do it. Maybe. But, so in other words, that this stuff has already happened with financials and all that. I just think that I see a lot of stocks that seem to be moving a lot together that wouldn't behave the same way due to interest rates and inflation and the strength of the economy is the other thing. So like an obvious concern now for people is recession, right? So if you think that short-term rates will rise enough that they'll have to, because the Fed raises them, that they'll go above long-term rates at some point, and that will cause a recession, which is probably a realistic concern that some people have about 2023 or 2024. There'll be a recession then. Okay, that might change your mind about certain stocks, but I'm not seeing that because I just mentioned like orange juice stuff. Mm-hmm. I mean, when we mention FRP holdings, not terribly economically sensitive things in the sense that like, there's some sensitivity to like, so how is it done? Is it done better lately?
All right, it's done 2.7%.
So you see that it's done quite differently in the last, how long is that? I don't know what that is, but they basically were the same as of midway through February.
Yeah.
And it's just in the last week or something that it changed. So, yeah, I mean, if you just try to find what stocks do you think should be the most insulated from that stuff, I'm not seeing a lot of differences. And so that could be positive in that you could find those stocks that have also dropped in line with the market. But the issue with that is that as much as people are saying, at least of the kinds of stocks that we look at, as much as people are saying that there's a lot of volatility and stuff, what I've seen this year so far is a lot of stocks down by similar amounts. There's just like a lot of stocks down, right?
Yeah.
But volatility would be better if there's a lot of stocks up, there's a lot of stocks down. Some stocks are down 10%, others are down 30%. We saw more of that last year. Not so much in the stocks that we invest in, because they weren't down at the same amount as these things that didn't have a lot of earnings and stuff. But some of the technology stuff was down a lot last year.
So because of that, everything, they're just kind of going down the same way. I mean, how are you thinking about that?
It's not that helpful.
No.
The market was a lot more overpriced than 10%. And if it all goes down together by only that amount, it doesn't really help you. And the whole rationale for like, well, these valuations are justified by the interest rates. I mean, I don't think that the change in stock prices is like been greater than would be suggested by the change in interest rates.
Assuming they only raise what, like what you were saying, what people think 4, 5, 6,
right? But let's say hypothetically, as of the beginning of this year, you were equally excited. We're not, but you're equally excited about owning a 10-year bond or the S&P 500. Okay, well now they're both down a bunch. Which one's down more? They're not. But I'd have to check. But a lot of bonds are down by amounts that are very similar to the S&P 500. So their yields are up, yes, but like you're getting about as much of a discount in them from the beginning of the year as you are now. So it's hard to say, well, stocks are more attractive compared to what? Houses and used cars have gone up.
Yeah, there you
go. So maybe stocks are more attractive compared to that. Stocks are more attractive compared to cash. At the moment, cash doesn't pay interest, but you expect it to pay interest shortly. So are you going to own stocks for a few months while you wait to get paid more? So that's the other issue. Like, say however many rate increases there'll be, then presumably you'll be able to make more money on cash that's sitting idle. And then it's just a question of how much that changes how you think. If 1% is enough for you, then that might adjust your thinking so that the stock market being down a bunch isn't a big issue. So it doesn't necessarily make it a lot more attractive. I don't think that it's more attractively priced versus alternatives now than at the beginning of the year. And the problem is because it's not, certain stocks aren't down a lot more, certain sectors and things aren't down a lot more than others, then there's not a lot for us to do. At other times there have been, and then we've mentioned it. A while back we talked about financials, and I think we talked a little bit about like energy, like fossil fuel. Those are the only things that I saw that looked reasonable, that looked like cheap. And if anything, those have like, it depends on what time frame we're picking. But if we're talking about over a year or something, they've somewhat closed that gap. Like they've done a bit better than the market generally. And so while they might still be more attractive than the market, they're not. There's less divergence between things and the prices that we're getting. There's been lots of declines in things we would never buy anyway. That doesn't help me.
Yeah,
it doesn't help me if Peloton goes to zero because I'm not buying at any point between now and zero.
Is this when Buffett would focus on workouts in special situations?
Yeah. So obviously that's something that you could do. I mean, you can buy Activision.
Yeah.
Yeah. I mean, you could short the S&P 500 and put the proceeds into Activision if you want to, if you're concerned that you have too much in the market generally. You could do all those sorts of things, which are the kinds of things that like Ben Graham, when he was doing hedges and things like that, would do that kind of stuff. How do I outperform in a flat market? You can invest in things like arbitrage, stuff like that. So that's one. There are some issues with that. We've talked about Clark Street Value, that blog. That's a good blog to read.
Yeah.
Deals do, like the Microsoft Activision was totally different, but deals do tend to fall apart if credit conditions tighten, the market falls, things like that. And so you have a much higher proportion of your deals fall apart. So doing arbitrage stuff is not as isolated each event, not as independent of the others as you might think. Now, I think specifically the Activision one's a little different. It's a very reasonably priced deal for the acquirer for something that size compared to other things in the market. They probably want to do it. There's antitrust concern and things like that. So it's more deal specific things of antitrust issues, of further scandal and stuff like that, of all that kind of stuff. More so than Microsoft, if it wants to do the deal, could do the deal without there being any credit available in the economy. They could do the deal in 2008 when Lehman's falling apart and stuff. So that's not the issue. A lot of other deals it is. So like most, because a huge amount of these are like private equity type things and whatever. And if, there's problems, then that will happen all at the same time. So you're not as insulated as you think you would be. And like I said, unless you're shorting something else or doing something else that generally tries to take out the market risk aspect of it, then it's still hard to outperform. And there's different ways that you can do stuff that combines. You try to find things that can make money even if the market doesn't do well, obviously.
Sure. Yeah. Do you lower your standards when you look at spinoffs? Like your standards from like a business quality standpoint? Is it more about price?
I try not to, but I think that Joe Greenblatt had a lot of success doing that. Yeah.
Because I've looked at different spinoffs and I'm like, we just would never buy this.
Yeah. The only two
from like a quality
standpoint.
Two
we talked about that would happen this year, I believe, maybe I'm forgetting one, is Swedish Match is spinning off a cigar business, machine-made cigar business, allegedly. And they've said very little about it, but they said second half 2022 at the earliest. So that might not even mean that. And Warner Discovery. Those are the only ones as businesses. And Warner Discovery is going to be carrying a lot of debt. And Swedish Match said it plans to put a lot of debt on that business. But those are, whether we would like the price, and I'm not sure we would in those cases, there's businesses inside of those things being spun off that we would like. And those are the right kind of industries and stuff. So those are the only ones I can think of scheduled for this year that we would be interested in probably. There were spinoffs not that long ago that interested me as the business quality. The price didn't interest me. Those were the main one of that was Otis, the elevator company. But I was all right with Carrier.
I'm just curious because you're so big on getting as much financial history as possible.
Yeah.
And the stability of the margins and having proof of this, which shows proof of the business, which shows proof of the customer. And you could learn a lot about the business from that. When you read a prospectus that has 3 or 4 years. It's like, how do you get comfortable with that level of financial data you're receiving to be like, yeah, this is a good business? Because at a minimum, we you said in the last podcast, a 3-year rolling average of free cash flow, stuff like that, right? So it's like, how do you do that with spinoffs? Because you can't do that unless they're public before or whatever.
I mean, I have a pretty good idea by reading the prospectus. Like I was reading the Discovery one, so that's Warner. What like bloggers will say it should be valued at, right? Because they do like, here's the adjusted EBITDA that we think we have. Here's what we think we're going to have in the future. Here are our projections. You take that, you find the comparables that are publicly traded, you put a multiple on it. And so that's how you decide whether it's attractive or not on a price basis. But figuring out whether all of the businesses in Warner and Discovery are as attractive as the ones you're comparing it to, yeah, that's harder.
Yeah, because putting a multiple on, that's easy work, right? I mean, like just slapping a multiple on like a math, I mean, that's Excel work. I'm talking about like all the work that goes into, the past history and understanding the business and stuff like that.
Yeah, they'll use Disney as a peer, and parts of the business are peer, but parts
a company like Warner that's been around forever. I mean, there's so much information where you could probably learn a lot about the business, the main players.
Oh, we know what their market share.
Market share, movie, everything. I mean, that's like a business that there's just so much information. But other companies,
the cable channels, like what they call their linear TV thing, not as much. I don't have good data. I mean, I read the thing. I don't have good data on their cable channels. So like you can have a pretty good idea of what's happening with HBO Max, with Warner as a movie studio, okay, things like that. We have all the information on Discovery. I don't think we have a lot of good detail on how the cable channels inside of Warner have done, and that's inside AT&T, so it's very hidden. And we have a little projection thing and stuff, and it's kind of interesting what they say, but it not good. I mean, from what you can tell, but it's hard unless we take and compare it to other companies in the same industry and everything. So, I think it's with the very big spinoffs, I think it's also hard. So those are tough. Much smaller is easier. It's easier just because you always get more information on smaller companies. The big companies, it's harder to get the information in big companies because so much of it is hidden by different segments of stuff.
Yeah, I mean, that's if a smaller company has like 2 or 3 revenue lines, they're going to list the most important, KPIs and stuff like that. It's easier to find that out just by the nature of the
together,
size.
Yeah. Yeah, we talked about that with tech things, the big, like the FANG type things. Netflix, we know what their business is. Some of the others, like Google.
You've always talked about Apple being tough.
Apple stuff. Google's very tough. Amazon at least is now admitting that they have advertising, and
Yeah, they broke that out.
I'm always impressed by those because I'm kind of impressed that the SEC and stuff hasn't said that selling what you sell in your retail business is an online thing, and like advertising and some of the other things they have are not remotely similar businesses, and you have to break them out. I would like it broken out more, and I think we've probably, as investors and regulators and stuff, have been too lenient on giant companies putting them all together, which I think is caused by the idea that everyone just cares about the overall number for the company.
Yeah.
And so not, saying EBITDA is EBITDA from wherever we're getting it from, I mean...
Oh, we love segment information.
Well, segment information from Disney's most recent quarter was very interesting. Everyone's excited about subscriber things and stuff. You see how much parks the parks, they call it parks and experiences and stuff, but you can see how much it made, how much domestic parks made. You can see how much streaming lost, Disney Plus. So, if you value the individual parts.
But that's what the multiples are. Streaming.
Well,
like where Netflix trades at on a multiple basis.
Right.
Now apply that to Disney.
Right. But that's interesting to think about that.
That's what people think.
So, but what is a Disney Plus subscriber worth? Right. Yeah. I mean, I think I think, I mean, Disney has a very large part of their business, which is totally different from the parks business is totally different from the businesses of the other companies that they're compared to. And yeah, I'm not sure that that analysts and people reporting on it and stuff give enough attention to that fact. I think it's disguised as part of the overall business. But it's very, very different and it earns a lot of money. So it's a very big part of it, and it is not even remotely in the same industry as these other companies that we're comparing to, doing streaming things and stuff. And I don't know how much of the stock response like is more to the streaming numbers as opposed to stuff for the parks thing and stuff like that. But you'll see it as a result in this year in terms of their earnings versus some other companies, because this year will probably be the best ever for leisure stuff is my guess. Not for business travel, but leisure travel, things like that overall will be the best, you know. Disney's not getting a lot of foreign right now because I was there and I saw the parks and there's very few foreigners there. And usually there's a lot. So its demand domestically is obviously the highest ever by far. But that's making up for the fact that there's not as much travel with foreign and stuff. But that'll come in eventually.
The forever company, Disney.
Well, we have to look at the price and look at all the businesses.
Yeah, let's look at a quick FS.
Because there's a lot of TV stuff that isn't TV and streaming stuff that, doesn't make money right now. It's either in decline or it's growing but not making money, but they're losing money on it. And there's a lot of having to be invested from that. So we'll see how it does over time. But okay, so the parks are making a lot of money, but a lot of the money from the parks has to be taken and put back into doing Disney Plus, with the idea that that will be successful at some point. And if you look at Netflix, right? So, let's see how much they.
What do you think is like?
That's not so, when you look at it, like when I'm comparing Netflix to the parks are for Disney and stuff, getting your business to the size and profitability of Netflix as it exists now, that's not that impressive compared to like the parks and stuff. Like Netflix in 2021 made $6 billion in operating profit. So it's got to be pricing in a lot more of what happens down the road.
Yeah, sure.
I'm sure that
value.
Yeah, that's true.
They fell like what 20 or 30% after an earnings release saying that growth is slowing.
Yeah, so I guess all I mean is that during 2021, there's no reason to believe that Netflix will benefit from a lot of leisure travel and things like that. Yeah. But Disney will.
Yeah.
So there'll be more of, even though they're seen as comparables and stuff, there'll be more of a divergence between those. Whereas people were doing like HBO Max, Disney, Netflix, those things all together as streaming things. We'll see. But I think that there'll be more divergence in terms of their financial results this year than in past years. So
cool. Well, I want to thank everybody so much for tuning in with the both of us here today on the Focused Compounding Podcast. If this is the first time you're tuning in with us, be sure to check out all the content we put on the internet. Follow me on Twitter at Focused Compound. And if you're interested in learning more about our money management services, reach out to me, Andrew at focusedcompounding.com. We have a fund for qualified investors and managed accounts for everyone else. Thank you so much for all the support, and we will see you in the next podcast.